Hello, and welcome to the final episode of Accounting 2301 Chapters, the lecture that we get to go with. And we're going to finish off with Chapter 12, and it's the Statement of Cash Flows. A relatively newer statement compared to the income statement and the balance sheet and the statement of retained earnings. This one started around basically when Enron went down, and we had to actually show investors where the cash is going, okay? So they can see the movement of the money. Basically, again, this is where the blood flow of a business goes, and why we are the heart of a business. So, why do managers and investors care about the statement? Well, again, it's a better predictor. It's a predictor of future earnings. But it also understands what's going on with the business. So, they break it down in a few other items, mostly from operations, investment, how they're going to expand or maintain capacity, and to meet its financial obligations, which is basically the financial side. It allows investors to actually see what's going on. Now, we're going to get you into the basics of the cash flow statement. We're not going to go too heavily in depth into it. It's mostly going to be dealing with more in the intermediate, where you get cash flow if you take the intermediate accounting class. We're going to get into the basics of it. Okay? So, I mean, what we're going to do is basically, again, get you the definition and how does it work. So, what's reported is operating, investing, and financing. And as you can see, this graphic right here is a good one to show you what adds and what subtracts. Kind of like what we've already done. How does cash work? So in operating, we get more money when we sell products or provide services. On the contrary, during operation, we lose money, or we basically use the money to purchase inventory, to pay our employees, to pay taxes, to pay any other expense. When we're looking at investing, we earn money when we sell, again, any of our fixed assets or any sales from investments. We finally sold those stocks or security. Okay. On the other hand, we lose money when we buy stuff. Okay. Even though the company needs it, we do lose money from it, or we basically buy the property, the plant or equipment, the fixed assets. We purchase more securities in other firms or other items that we need to do. Financing, on the other hand, this again, how does the company basically finance or be able to pay for this stuff sometimes? And that includes issuing out bonds, stock, getting a loan from the bank. Those work. On the other hand, we lose money when we pay out dividends to shareholders because they basically invested into us. And we either repurchase common stock. So there's a lot going on here. And we're going to get you the basic definitions. So, cash flows from operating activities are any cash flows that basically affect net income. Okay? They're going to only affect net income, really. There are typical everyday type transactions, such as buying and selling inventory, as their example again. But again, it's basically what we do every day. How does our cash move? Do we increase or decrease? While cash flow from investing is transactions that affect investments in non-current assets, mostly our fixed assets. So when we're looking at investing, we're usually looking at fixed assets and basically amortization, stuff like that. Something that's not usually we buy like constantly. And then again, finance is cash flows, that transactions that basically affect equity or debt in the business. And of course, buying, selling stock, or issuing, buying back stock, dividends, and bonds, stuff like that. Okay. When we look at there is two methods that's involved with operating. Okay. So we're going to break down each one as we go. And the operating does have two methods. One is the direct method, which basically reports the sources of operating cash and uses of operating cash, basically. But it's only really used by 1% of companies. And it requires a lot of information that's usually not available to us, and that we're going to actually have to go research and items like that, which raise costs. And again, we're in the cost effectiveness stuff. So since it's only used by 1% of companies in the real world, we're not going to really go with the direct method here. We're going to actually do the indirect. Indirect's a little bit easier to actually understand too. A lot less research. We already have everything for us. And this basically reports operation cash flows by beginning with our net income, okay, and adjusting for revenues and expenses that do not involve the receipt or payment of cash. Basically, we're going to remove anything that doesn't deal with cash, okay. So when we use the indirect method, it does require information from basically all three financial statements that we already know. And our objective is to find the net cash provided by operating activities. So, starting off, we're going to use Rundell Inc. And here's their income statement. It's a nice, pretty, awesome income statement. And we have sales, cost of goods, gross profit, again. We got depreciation, other operating expenses. We got a gain or sell from a land, and interest expense. Okay. First thing we want to start with is our net income. So we're going to start with net income, and then we're going to adjust it for anything that's really non-cash or not really dealing with something other than sell of a fixed asset too. Okay. So the first one that we go with is any expenses. We're going to look at expenses first. And the one major non-cash expense is always going to be depreciation. Okay. So since it's depreciation, and notice that depreciation also works with fixed assets, we're going to basically add that back into our net income. The reason why is because this is subtracted from the overall sales to get to the net income. So we're going to add that actually back in. Next thing we tend to look at, again, is anything that's a sell or a loss, gain or loss, basically from fixed assets. And you're going to see it right here. We have a gain on the sale of land. Now, with a gain, you would actually subtract this from the net income. The reason why is because, again, a gain would increase how much income we've had. So since this is not dealing with actually operating, it's a special thing, we actually get rid of it. Okay, we have to get rid of it by basically subtracting it out. Now, if it was a loss, it will be just like depreciation. We would actually add it back in. And here in the notes, this is exactly right here. So pay attention to these items in bold. I will tell you there, because it does go step by step. Okay, just like I'm going right now. Alright, so now we look at the balance sheet. Okay, so again, I'll piece this all together. It's all in your notes of how the operating looks. So we've already started with the income. We've added back 7 grand and we subtracted 12 grand, which in reality difference is what, 5 grand that we've actually lost. So we should be at 103,000 right now. And now we're going to go to the balance sheet. We like comparative balance sheets. Okay, when we do cash flows, we have to compare 2 years because we're looking for increases and decreases. Okay, so we're really looking for those items, and what we're going to be looking at is a few non-cash asset accounts. Okay, and that's going to usually be accounts receivable and inventory. They're going to be our big ones. Okay, because it actually shows cash flow of actually customers basically either we're billing or we got money in between the years, or inventory, we bought inventory, we just haven't sold it yet, and they still deal with the actual cash flow of money being basically used or being included. So we want to deduct increases in non-cash current assets and add back decreases in non-cash current assets. Again, we look at only current. Okay, we're not looking at long term. So land, buildings, accumulated depreciation, we're not really dealing with. Okay, that's fixed assets and they're long term. It's always current. Okay, so we could have more current ones. We could have CDs, savings accounts, stuff like that. But right now, we want to look at any change that's not cash itself. Okay, so accounts receivable, we have 9 grand. We also have 8 grand increase also with inventories. So we want to deduct both those increases. Okay, if one of these was a decrease, so if it was actually in parentheses, it went down instead of in 2015. Oh wait, that is a decrease. That is a decrease. Sorry. I'm used to parentheses, but that is actually an actual decrease of inventory. So inventory is going to get added back. Accounts receivable is going to get subtracted because that one increased. As you can see, from 15 to 16, it went up. Inventory actually went down. I wish they actually did parentheses, but because that's the common thing you're going to see, like right here. You'll also see in here. I don't know why they went with the asterisk, but again, from seeing those, we can tell which ones we need to add back and which ones we need to subtract. So again, with a decrease, you need to add back. That means we actually sold more inventory or it went obsolete. So those decreases get added back, while any increase between the 2 years actually gets deducted. With current liabilities, we're going to do the opposite. Okay, so looking at our current liabilities right here, we're going to see accounts payable actually has a decrease. Accrued expense payable increased. Income tax payable also basically decreased in itself. If they increase, like our accrued expenses, we need to add back that increase. It's showing that we have more cash that we actually accrued, so we haven't actually paid the cash yet, so we need to increase our income. while we need to deduct any decreases. Okay, because this actually shows that we've actually paid off our liabilities, but they're not affecting the income statement itself. So they only affect the balance sheet. So that's the one reason why we need to basically deduct any decreases to show that the actual cash flow was used to do that. Okay, so here we go. This is the adjustments to net income using the indirect method. This is our little graphic. This is where all the numbers actually come in, and a good way to also see what we subtract and what we add back. First off, again, we start with our net income. We're going to do any adjustments starting off first again with the income statement. So depreciation of fixed assets, we're going to basically we basically end up again adding those back. Any amortizations we add back. Any losses of any disposal of assets we add back. Gains we're going to decrease, so we're going to subtract any gains. Then we're going to go look at the balance sheet. Again, we're going to look at any increases in non-cash current. They're going to basically subtract. Any decreases we're going to add to our net income, and the same thing, just the opposite with liabilities. So right here again, it shows actually when we add or subtract, but we gotta have that comparison for our balance sheet. Okay, so with that being said, this is basically a why. Okay, so why do these rules make sense for changes in current assets and current liabilities? Even though I did try and explain it again, we're going to, this right here really does start of why does it affect. Okay, if a business makes a sale on account, both sales and account receivables increase, but it does not affect cash. Cash doesn't affect until we actually receive the cash from the customer. Okay, so since it does not increase net income, or it does increase, but since we're looking at cash flow, we didn't receive no cash. So any increases in accounts receivable does have to be subtracted out because it's showing a sale and an increase to our net income, but no cash involved yet. Okay. Same thing with the payables. Again, it doesn't affect cash. We must get rid of it. Okay. We're trying to find out how is cash being moved. So again, more on the operating right here. The 9,000 increase in accounts receivable indicates 9,000 revenue recognized in net income that has not been collected. Therefore, it has to be deducted. The 8,000 decrease in inventory does indicate 8,000 of inventory was expense, which required no cash outlay in this period. Basically, we expense out stuff we've already bought, and therefore we need to add it back. And the same thing with these right here with the liabilities. So this is a good way to explain how things are going. Why is it going? I mean, again, the decreasing in accounts payable indicates that we paid cash, but it doesn't reflect in the net income because it's already been recognized. So we must deduct it. While the increase is expense recognized that did not require a cash payment, and therefore it should be added back. Okay, so again, all we're really trying to do is figure out exactly the cash payments, and this is why in intermediate, we dive deeper into it. Here, we're trying to get you the basic understanding. Okay? So in the end, this is what ends up happening. This is our overall using our example. Again, we started out with the net income of $108,000. We added back the depreciation expense, since again that doesn't use cash. The gain on sale of land, that's dealing with a fixed asset, so we must subtract that out because it was a gain. And then of course, all these items that really don't affect cash in itself when it deals with the income statement, because we either already recognized or we're recognizing and there's no cash that was actually involved. So increasing accounts receivable, again sending out bills but no cash yet, we have to deduct. Inventory, that was expensed in this current period but we've already paid for, we must add back. Decreases in accounts payable, okay, again doesn't affect the net income, so we must subtract. Increases in accrued payable, we're basically recognizing the expense but no cash has actually been paid out, so we must add that back in. And any decreases in tax payable, just the same thing as accounts payable. Okay? Alright, so that's operating. I know, operating is probably the most confusing one. Okay? So in your homework, we're going to get into some of these questions, but really, I mean, just understand right here is this right here. If you understand this, what's being increased and what decreased, chapter 12's actual one is not that hard. Okay, it is just learning that aspect of what gets decreased and what gets increased. Okay, investing is a little bit easier to understand when we actually look into it. Okay, when you see cash flows, we're basically looking at any purchases or sale of any long-term assets, namely fixed assets. Okay, and the rule is basically this: we add cash received from any sales, and we deduct cash paid for purchases. Okay, nothing really different on that part. So in our example, we actually had the sale of land. So for land, we notice that the account decreased by $45,000. We do need to know more, so we go look at the ledger for our land itself. And we see right here, we sold for $72,000 in cash of our land, and we purchased $15,000. So, as we can see, on June 8th, we received $72,000 for the land, which is a positive cash flow. So it increases our actual fixed asset or increases our cash. Okay, we decreases our fixed asset, increases our cash. But then we paid for another $15,000, which is a negative cash flow. Again, we paid, we lost cash. So again, when we're looking at cash flows, we're really looking at how does our cash move. For the building, we noticed that $60,000 was increased. Basically, we purchased the building for cash. So, since we purchased a building for cash, we paid $60,000. So that means another negative cash flow going on here. And really, that's it. That's all we're doing is looking at these transactions of fixed assets. Did it increase our cash or did it decrease our cash? Now, if we had our bartering system that didn't affect cash at all, then we don't worry about it, okay? Because that's not cash. Cash wasn't involved. All we do is look if we sold something or we bought something in our fixed assets. The third one is financing activities. And again, this one is following simple rules. It's going to look at a few accounts and it's going to see how cash increased or decreased. Now, remember that we got all this stocks and bonds from Chapter 10 and Chapter 11. So now we're actually looking into it and how it affects our cash flow. So, think about this, of any issuing our retirement, basically buying back long-term debt, or equity transactions, such as issuing stock or dividends. Again, this is a balance sheet item, and we're going to note common stock for this time has increased with additional paid-in capital. So we issued 4,000 shares for cash. We have 8 grand. We also basically have paid-in capital of 40,000 in cash for that issue of 44,000 shares. So how much did we actually receive? It was about 48,000. And again, this is a positive cash flow. This is money that came into us for basically financing some activities by issuing out stock. Then you check dividends. Okay? So, check how much dividends were paid. Well, cash paid right here shows it right here in the dividends payable, and it also shows cash paid again right here of 14,000. So how much cash was paid is the combination of these two. Don't get confused on dividends declared. Again, dividends declared, we did not pay out cash. Okay, we did not increase our cash. Dividends, we usually always pay. So we're going to look for any debits really to dividends payable. That shows that about 24,000 actually went out, or a negative cash flow. Again, we lost cash. So here, again, bonds payable. We look at here, we retired by a payment of cash at face amount of 50,000. So we have a $50,000 negative cash flow. So again, we lost money. So investing and financing are usually the easier ones. All we're doing is seeing how did cash work. Operating takes a little bit, and again, that's all dealing with increases and decreases in our current assets and liabilities. So overall, we can actually piece this together. Okay, here was our operating that we did before. Then here is investing, which we did the cash received from the sale of land, and what we paid for purchasing of land and buildings. So we actually have a $3,000 loss in cash, or the flow of cash, in our investing. That's not bad. That means we're actually buying and we're expanding the business. So investors are not going to look too bad on that, unless it's like a way above loss number. Then they question. Or if it's very positive. Why are we having a positive? Why are we reinvesting into the business? That could be also a reason. Here we have the common stock of our financing activities. As you see, cash flows from financing. And again, you see the cash received, and then you see the payout and retirement. Again, we have a loss. That shows basically more of a negative cash flow. And again, investors may like this. As they can see, we paid off bonds, we paid out a dividend. So investors do like that because they know they're getting a dividend. Again, we don't want to see an outrageous amount, but if we can, they're paying off most of their debts. That means the business is running good. And if we see a huge positive, we're going to be questioning, why is there so much financing going on? Is the company in trouble? So those are questions that we actually ask. But here, you actually see the total increase of 71,500. Then you're going to see these two. We're going to look at cash at beginning of the year, and we're going to add those two up to get our cash at the end of the year. So again, these three get added together, and that's why we got 71,500. Then we add in our beginning to find our ending. What we're going to look at is we're going to go right back to our balance sheet. So going all the way back to the balance sheet, there's the 26,000 that we added back, and we're going to look at this. This is our ending for 2016. We want to make sure that is correct, that balances to our cash flow. Notice also this, increase, decrease, 71,500. That should also match if we're doing a comparative balance sheet. So if we look at this, look at that. There's the 71,500. That balances. So if we added it in, it does tie right back to the balance sheet. Okay? If it doesn't, that means that there is a mistake, either on the balance sheet or in our cash flows. Most likely, sometimes it's the cash flows, okay? So, we want to make sure this matches our ending balance in our cash account, okay? So, again, this shows chapter 14. It's actually chapter 12. So, let's look a little bit at the workout problem right here. On the basis of the following data for Larson Co. for the year ending December 31st, 2015, and the preceding year ending December 31st, 2014, prepare the statement of cash flows using the indirect method of reporting cash flows from operating activities. In addition to the balance sheet data, assume that some of these items happen. So first off, know if it's going to be investing or financing or operating. Here we see equipment. Equipment was purchased for cash of $125,000. That's investing. Again, this is a negative cash flow because we purchased. Equipment costing $85,000 with accumulated depreciation of $65,000 was sold for $15,000. Okay. We don't mind the cost or accumulated depreciation. What we care for is what cash we got. So if it's sold for $15,000, that means we increased our cash for $15,000. Then this says we issued stock for cash. So if we have any changes in common stock, there should be an increase in our cash. So again, here's actually what's going on. So it actually has to show some depreciation expense that's going on. That's we probably gonna add back, but really we have 15,000. Again, if the balance sheet or the income statement doesn't show the loss, we probably need to add in the loss. Okay, so that's what's going on right here. Because again, I didn't see any of this. I'm just going through the steps. So we have a loss. So depreciation expense must be $65,000, greater than the difference on the balance sheet. Sold at a loss of $5,000. Remember to add back to net income plus our $15,000 investing activities. So we have that negative $8,000 plus $65,000 equals about $57,000. Alright, yeah, because 65 plus 15, that's only 80,000, so $5,000 loss. So we're going to have to add back the $5,000 because again, that's a loss going on. And that's going to show up on the income. Okay. Stock was issued. And the only entries in the retained earnings account were net income of $51,000, which we're going to need to know, and cash dividends declared of $13,000. Okay, remember this was declared, so we're probably not going to have too much to deal with that. Okay, so here's our comparative, which is nice and handy. We like that. Let's see. So one big thing you want to do is make your difference. Okay, let's see if it'll actually. There is none. So we can make our difference going on right here. If we took 100,000 minus 78,000, so minus 78. So this one increased by 22. Okay, if it's in red, still doesn't show. So 22,000. We have an increase right there because it went from 14 to 15 and went up. Inventory went down, as we can see. 85, 78,000. That looks like it went down by 7,000. So again, I would put in parentheses. Alright, never mind, that's accounts receivable. Sorry. Inventory went up, looks like by 11,500. Equipment, I'm not worried about. Don't worry. I mean, accumulated depreciation. Now I want to know the current, okay, and especially the cash, because that's probably my goal in all three. Okay, accounts payable. Looks like it went down by 20, well, increased by 2,500. Cash dividends payable went down or increased by 1,000. So that's interesting. Okay, we declared 13, but only increased by 1,000. So we probably have a sale going on there. Common stock increased by 30,000. Paid in excess increased by 2,000. So we got financing right there of 32,000 going on. And of course, retained earnings already has all that. Okay. So we need to watch out for that, especially on the dividends part. So let's go ahead and start knocking this out. So first thing we always have to do is put our header in, which of course our header is not in. So it's whichever company we've got. This company is Larson Co. And this is the statement of cash flows. So if you need to go, you can actually look back up here. And notice again, it's always for a period because it's a statement of cash flows. So for the year ended December 31st, 2015. Okay, and I doubt I have anything in here because all my program is gone. It happens. Oh well. So first little part we're going to have to do is cash flows from operating activities. So cash flows from operating activities. And we always start with net income. Okay, so even though it's in two columns and looks like credits and debits, don't fall for the credits and debits. Okay, what we're going to do is the same thing we did up here. You're going to have everything added, and then the total is going to fall into that line. Instead, I'm not going to have this third column. Okay, so 108 was up here. That was our net income. So here, our net income was 51,000. So 51,000. And then we're going to deal with our adjustments to operating. Alright, let me make sure I put it exactly like they do it, because I don't want to confuse you. Adjustments to reconcile net income, cash flows from operating. So basically adjustments for cash flow of operating. Again, these are formatted all in different ways. So however you're basically in your firm or business, they'll tell you this is how I like it. Here, I'm going to go simple. One, saves time. So depreciation. So depreciation expense in itself. That's our first thing. This one really says only accumulated depreciation. So depreciation expense must be 65,000 greater than the difference on the balance sheet. All we know is that it was sold for a loss. So we don't actually have the information for depreciation. So that makes it a little bit tough right there. Okay? So we're going to just say that 57,000 was depreciation expense. That's what we're doing right here. Basically the difference right here, getting rid of the accumulated depreciation. Okay? We're just going to go with that. It helps out in the long run. But again, depreciation should be added back. And this one I'm going to question a little bit. Because again, this is the example from the book. So let's see if we actually have to deal with that depreciation. Again, 22,000 is what we're going to get to. So we're again going to show you a few little items that we probably going to have. Alright, so depreciation expense, we check that off. Check. Now deal with any losses in sales. So loss in sale of equipment. And that's a good old 5,000. Again, 65,000 plus 15,000 only gets us to 80K. So we've lost 5,000, and with losses we must add back. If it was a gain, we subtract. Okay. Oh, gotta remember, can't do that. All right. So next, let's look at our current assets. Accounts receivable. It decreased. So with a decrease, so when accounts receivable decrease, we must actually add that back. Okay, so we're going to add back 7,000. Again, if we have to, look back up here. So any increases, increase in accounts receivable, decrease, we must decrease. Okay, so we must add back. Sorry. So decrease, we add back 7,000. And we have an increase in inventory of 11,500, looks like. So 11,500. And again, when an increase of a current asset, we must deduct. It's going to be the opposite with our current liabilities. We only really have accounts payable. Cash dividends payable is a finance thing, so we don't have to worry. So we have an increase there. So increase in AP, and we must add that back. So they actually follow the rules. Increase, increase. So 2,500. Okay, that's all from our operating. So again, look at our cash flow, and it tells us net cash flow from operating. So net cash flow from operating. Okay, and then we just take all those. So 51 plus 57 plus 5 plus 7 minus 11,500 plus 25 equals about a positive 111,000. Okay, now we look at cash flows from investing activities. Okay, so here again, this is where we put in any cash received or any cash that we lost. So here, this is where our equipment is. We included 15,000 investing activities, but we bought basically, so purchase of equipment, and you can do it either way. So I'm doing the purchase first because that shows up first, of 125,000. And then we sold equipment for 15,000. Again, cash went out to the purchase, and then cash came back in for the sell. Nothing else really happened. Okay, so 125. So that means right now our net cash flow from investing is a good old whopping loss of 110. So didn't do real good. We got good cash flow loss going on. Okay, next one, cash flows from financing activities, and we're going to look at basically dividends and common stock actually sold. Okay, again, cash dividends payable, it increased, but we declared 13,000. Okay, so really right here we probably actually sold a good old, as we can see, we have 5,000 left, so we used up the 4,000. We have an additional 5, basically 5,000 minus 13,000 should get us to what, 8,000 that we actually paid out. So we actually have 8,000 that got paid. I don't like it when it doesn't really give us the amount, but when we look at it, declared, so if we did a T-chart and this is our ending balance, we started out with 4, we declared 13, so plus 13 minus 5,000 for our ending, we actually paid out 12,000. So that's how much we actually paid out, was 12,000 during the year. Okay, so again, we started out with 4,000. We declared another 13,000 for our one, and basically we're going to subtract out the ending. So in reality, we had a 12,000 cash movement. Okay, so again, start off here with financing. We're going to deal with anything that we earned or paid out. So sale of common stock was a total of $32,000. That's the change. Okay. And then basically paid dividends of $12,000. Again, there we go. So net cash flow from financing looks like a good old 20,000. Okay, so we had 20,000 that actually happened. Next, we actually do increase in cash, which is the addition of all three of these. So increase of cash, and that's going to end up being about 21,000 that we actually see, because of 111,000 minus 110,000 leaves us with 1,000, and we had 20 in financing in itself. Okay, cash at the beginning of the year, we had 78,000. So So 78,000, and then so I can already tell there's 1,000 off because there's supposed to be 22 right here. So I'm thinking the book's actually trying to add this extra 1,000 that increased. But if it did that, that's a little bit off. So there's $1,000 that's somewhere missing that they did not execute, or I did my math wrong. So and I don't think I got anything wrong on the changes. I'm double checking right now, guys, just to make sure. No, I didn't have any change right there. So, and this is financing. We did the finance right. Because if we subtracted more, if we did 13,000 here, that would be 19,000. That's 20,000. That won't work out. So there's $1,000 missing that apparently we did not get the information for. So that's interesting. Do again. 51,000 plus 50. Sometimes you have to check and double check. Okay, so because they're saying this, so this is actually interesting. They didn't provide us enough information to find that 1,000 that's a little bit off. Well, this is a good way. There's fraud going on. But this is a way to find out, again, because this is saying that ending cash should be at 99,000. So there's a ending cash. Let me see how it says. Ending cash at the end of the year. Okay. So really, if we follow everything that the book gave us exactly as they did, which double check my numbers, everything is exactly the way that they said, there's $1,000 that's actually missing. Okay? So, let's look at this. 214. So that's 38. So, that, I mean, there's nothing wrong. I mean, it's just somehow there's $1,000 missing, and it's looking like that's supposed to be with the cash dividends, but that's a payable going on there. So the only thing I can think of what they're trying to tell you to do is they kind of mess this up a little bit because it's really not part of operating. Is that because dividends is right here? This is where dividends is. But I think they meant to actually have another payable that actually changed and end up doing this. So this is the only thing I can think of that the book made a mistake, and it happens. So because they're thinking increase in dividend payable of 1,000. So if there was actually that 1,000 payable, this would have increased to 12. Then this would have been 22, and then that would have been 100. But I think they made a mistake right there. I think they meant to have another payable that had the increase of 1,000 to get you to 22. So that is really interesting on how they did that aspect right there. Or they may have meant to add 3,000 right there. There's no telling, but that's the only thing I can think of that they made a boo-boo. That this was actually supposed to be a different payable to dividend. But that's it, guys. That's going through. So this has been the conclusion of the adventure of Accounting 2302. If you have any questions, please put them in the comments below, and I will answer them as quickly as possible. But this is your professor signing off for the last time for lecture videos. Professor Naragon signing out.